Hello everyone, my name is Majid Rahimi and you're watching part 13 of our classical technical analysis course. You can reach the first video here if you want to watch this course from scratch. Don't forget to click on subscribe button and the notification bell under this video to get notified when I upload new video. In previous videos, we looked at price patterns, either consolidation or reversal. In this video, we are going to explain some points about gaps. We will see which gaps are important, what is the common or area gap, breakaway gaps, continuation or runaway gaps, exhaustion gaps, and finally the island reversal, which is related to gaps. Okay, first let's define gap. What is a gap? A gap is a price range which no shares changed hand. This means that we see somewhere inside the chart that no trades have been took place there. In daily chart, it happens when lowest price of a day is higher than the highest price of the previous day, or when the opposite happens. We have of course some gaps inside the day which is not visible in daily chart, and you should go to shorter time frames to see them. We need another definition before we start looking at different types of gaps. What does closing or filling a gap means? When someone says a gap has been filled or closed, that means the price has moved back to the original pre-gap level. In the picture you can see an example of a closed or filled gap. 3 days after the time which gap is visible, the price is raised and break the upper level of the gap and see the pre-gap level again. After knowing these necessary definitions, let's see which gaps are important. If we can see which gaps are unimportant, we can consider the rest of them as important ones. We should first eliminate these gaps from our consideration. The first type are small gaps. These kind of gaps are very small and hard to see in chart, and they are useless and have no forecasting implication for us. The next type are frequent gaps. When there are lots of gaps visible in some chart and they happen frequently and habitually, they lose their importance. And finally, the third type is ex-dividend gaps. In the stocks markets, shares experience different types of dividends. All the gaps after any kind of dividends are useless for forecasting. We consider other 4 classes of gaps as important gaps, which we should watch them carefully. These gaps are common or area gaps, breakaway gaps, continuation or runaway gaps, and the exhaustion gaps. The first one, the common or area gap. They occur within a trading area or price congestion pattern, like inside triangle or rectangle or other price patterns which show decrease in trading activity inside them, as we discussed in previous parts of this course. Most of these gaps are closed within a few days, except those which occur in the last move before breakout of price. The importance of this kind of gaps for us is for detecting an area pattern and formation of price. This picture shows us 2 common or area gaps inside a rectangle, which both of them are filled after a few days. And you can also see how this rectangle hits its target after the breakout. The next important gaps are breakaway gaps. These gaps happen after price congestion and at the breakout of the price, so they can easily be detected. Most of breakouts through horizontal pattern boundaries are likely to be attended by a gap, like for example in breakout of right angle triangle or breakout of rectangles. These type of gaps are important because they can help us detect the breakout. And they also show us how strong is our breakout. For example, in the same equal condition, we would choose the stock with breakout including a gap instead of choosing another stock with a gapless breakout. Most of the times, these gaps wouldn't be closed in short-term movements of price, especially if the volume in the upper part of the candle of the day that breakout happens become high. Here's an example of a breakaway gap. You can see how price goes down after this gap, and this gap isn't closed in a short time. The next type of gaps, which are more important than previous types, are continuation or runaway gaps. These gaps occur in the course of rapid straight line advances or declines. So you can distinguish this type from previous ones easily because it's not related to price congestion. These gaps show us a strong trend. We can also have a target measurement for them. This example shows a runaway gap. For measuring a target for these gaps, we should measure the movement before the gap and apply it after the gap to see the target. But this measurement is good for getting out of the market than getting in. And you should also be careful that you should apply this measurement rule on semi-logarithmic scale chart to get best results. The last important gap is exhaustion gap. Just like runaway gaps, they occur after a rapid, extensive advance or decline, but they do not show us continuation in trend. They show us the end of the movement. So it would be important to know the differences. Exhaustion gaps are quickly closed, most of them within 2 to 5 days. Unfortunately, detecting the exhaustion gap or distinguishing exhaustion gap and runaway gap cannot happen immediately when one of them develops. Here we can say some rules which can help recognizing each one. Watch the activity in the day which develops gap. If volume is extremely high, but price is not going as volume goes, it's probably an exhaustion gap. This is the best test you can perform. You can also use this rule. If price is near the target of previous pattern, we are probably facing an exhaustion gap. And exhaustion gap is usually wider than runaway. This width is different from stock to stock, but this rule can help you detect exhaustion gaps. Gaps shape an important reversal pattern called the island reversal. It's a compact trading range separated from the move which led to it. In the chart, it's easy to be detected because it's somehow isolated from the rest of the chart, like an island inside the sea. It's not a sign of major or even intermediate reversal. It's a sign of minor reversal, and it can, for example, shape the head in a head and shoulders pattern. And it's useful for us in these situations. Let's see an example of this pattern in real chart. As you can see, there's a separated price range at the top of this chart It's after an exhaustion gap and then followed by a breakaway gap, and you can see how prices fall after this pattern. Well, we talked enough about gaps. You can look at charts and detect different types of gaps there and see effects after they develop. We will talk about support and resistance as one of the most important concepts in technical analysis, which many traders still have some problems using them. Share our videos with anyone you think that might need them. Thanks for watching, have a good time, and bye.